Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and I'm speaking today with Justin Huhn, founder and publisher of Uranium Insider. And we'll put a link down below to Uranium Insider so you can follow along with Justin's work. But it's always great having you on the show, Justin, just to get a sense of the lay of the land on the macro side in the uranium and nuclear fuel sector. And then also, I'm sure we'll migrate down the food chain into the uranium equities, which a lot of people listening invest in the sector because of the volatility and sometimes explosive gains or explosive losses that you can have in the uranium equities. But let's start with kind of the health of the industry as a whole. We're seeing spot prices that have had a really big move. If you think about, it's been almost a year since we've talked to you. Prices were, in the 50s and 60s. Now they've gone above 80. Some have seen this move as maybe going parabolic, but others that follow the sector still think we could see triple digit uranium. Just from a pricing standpoint, let's start there, Justin. How are you looking at where things are at in the spot pricing?
It's been an incredible year so far for the commodity itself. And I say so far, we only got little more than 3 weeks left in the year. So for 2023, it's been a phenomenal year for uranium. Across the fuel cycle, pretty much everything has been moving up. That's all of the services and products across the fuel cycle. But uranium itself has really shined. We've seen the U3O8 spot price of uranium rise from year end last year was in the high 40s, sitting now here at $81.50. It's been an enormous year. It's up, 70% for the year. It's been incredible. The equities have followed as well. Equities, generally speaking, have done really, really well this year, although they've struggled to keep pace with the commodity itself. I attribute a lot of that to just general investor sentiment, not for this sector specifically, but just in general. Seems like most stock investors are expecting a recession, are expecting rate hikes to come down in a lagged effect on the market. That seems to be pretty much almost a universal sentiment. So I think that has kept some capital flows from being what they could be. But we watch the ETF flows on a daily basis, and money continues to flow into this sector. So we've definitely seen a lot more institutional positioning into the uranium sector this year. That's a very good sign. And we think we're on the cusp of a move where the smaller cap, mid and small cap explorer and developer stocks will then catch up with the large cap producing stocks that have really shined this year.
Well, Justin, I'm glad you brought that up because a lot of people have noted that despite the big move in the stocks, they really didn't keep pace with how fast the U3O8 pricing was moving up. Now, we have also seen an increase in term pricing and some deals that we've seen that have been a lot higher than people were expecting a couple of years ago. We're finally getting to those points where we're getting near incentivizing some production to come back online. Maybe speak to people that aren't as familiar with the uranium sector about the differences between the spot market, which in a lot of other commodities is the market you use, versus the term market and how that relates to the companies that actually mine U3O8.
Sure. Well, the spot and the term market, I mean, very simply could be defined based upon the period of time for settlement of a transaction. So the spot market essentially is 12 months settlement or less, and the term market is everything else. With all of that said, they're very, very different, even though they're sort of the same market. So they're different in the way that the spot price of uranium is something that is quite visible to the public. It's what investors tend to watch because it is updated in some cases multiple times throughout the day, but at least once a day, coming from the primary price reporter, nuclear fuel consultants put out a price every day for the spot price. If the term price, they only update once a month. However, the term market is where the utilities secure more than 85% of their needs for uranium and everything else in the fuel cycle. So utility, generally speaking, will secure its needs far out into the future with long-term contracts with producers. So if you're a nuclear utility fuel buyer, you tend to have direct conversations with producers, or sometimes you'll put out an RFP, a request for proposal, into the market and say, I need X amount of uranium for these years to be delivered on an annual basis. And then you get proposals from various producers that respond to that RFP, or you have a direct conversation. You literally call up Orano, or you call up Cameco, or you call up Kazatomprom, and you say, this is what I need, let's make a deal. And that is how most of the uranium needs are met in this sector, is through long-term contracts. So for the previous bull market, we had about a 5-year period where we had replacement rate or in excess of replacement rate contracting. So that's basically taking a snapshot of the annual burn rate of the global reactor fleet, putting that into a number of pounds. So right now we're looking at somewhere in the ballpark of 180 million pounds consumed this year in the world's nuclear reactors. And then comparing that to how many pounds have been signed in long-term contracts. So this year to date, it's 153 million pounds. That reporting, of course, doesn't grab all of those contracts, about 85% of the market. So we're probably actually pretty close to replacement rate contracting this year. Now, we haven't seen that since 2012. So it's been more than a decade since we've seen this quote unquote replacement rate contracting. And that has a lot to do with the demand hit that happened when Japan shut off all the reactors after Fukushima Daiichi accident. Has to do with Kazakhstan ramping production in the previous decade, et cetera, et cetera. So all of that excess supply that came from a reduction in demand and an increasing in production coming from Kazakhstan led to an enormous amount of above ground mobile inventory. That has taken years and years to work through. We are fully worked through. It's a very, very thin market. And so we're looking at another year ahead of us for 2024. We believe will be another year of probably replacement rate contracting. We know that utilities have a lot of buying ahead of them still, and the producers are mostly sold out of uranium for the next few years. So it should be pretty interesting, Chad.
Well, and it brings up a point about where uranium prices should be, which is obviously somewhat subjective based on how a utility company may look at it versus a hedge fund versus a commodity trader versus someone that's following the uranium equities. But you made a great point on a recent interview you did on another platform that there's no real logical reason that uranium prices should be at $81 versus $71 or $91. There's not a legitimate logical reason of why it's there. So maybe just speak to how the pricing gets moved around by different types of traders in the market, be they commodity traders or hedge funds or utility companies, buyers in the spot market, and what the actual companies need for incentive prices.
So incentive pricing is really interesting. So if you look back at, let's say, the early stages of this investment for me, which was 2017, 18, 19, those were kind of the early years for me for this investment. And it was still very much a contrarian investment at that point. You know, when I first started looking at the sector, it was just off the bottom for the commodity 2017. So we're $20 a pound, you know, low 20s. And it stayed in the 20s for another couple of years. And during that period of time, what you're really basing a thesis around is literally just structural supply and demand. How much inventory is out there? How much buying do the utilities have to do on an annual basis and then going forward? And how much supply is there? How much supply will there be? And you can base, you know, a thesis around modeling and looking at that. And essentially what you're betting on is where does the price have to go? So if we're looking at a supply deficit, in order for the market to be balanced, XYZ projects would need to be developed, and at what price can they be developed? That's really kind of the core thesis back in the early days. Had nothing to do with a resurgence of nuclear energy globally, had nothing to do with financial buyers coming in and buying uranium, so quote unquote secondary demand. Didn't have to do with any sort of assumptions around enrichment tails. It didn't have to do with production being shuttered necessarily. It just said, okay, the price is $25 a pound here. Where does it need to go eventually, somehow, some way? And so then you look at incentive pricing for the projects that would have to balance the market, and that would give you a number. So back then, we were looking at probably in the $60 a pound, $60 to $70 a pound range, because that's the price that, you know, the large low-grade uranium deposits would need in order to get developed. We're talking primarily, this is Namibia. There's a few development projects there with, 100 to 200 million pounds each, low grades. So they're higher cost projects. So, but they do need to come, and especially now, those projects are needed. They will get developed someday. So what price do they need? So back then it was a bet on $65 uranium. We're here at 25. Cool. I'll buy a bunch of the equities. I'll just sit back and let it happen. That's pretty much the thesis back then. But that incentive pricing now, it's almost irrelevant because we have such an incredible supply deficit now, and we have a lag time. So there's a lot of development projects that would be absolutely printing cash hand over fist at $81 a pound uranium. It doesn't matter. It still takes years and years and years to develop. One example would be NextGen's Arrow at the Rook I property in Athabasca Basin in Saskatchewan. This is an enormous project, a couple 100 million pounds of uranium. They can produce potentially up to 30 million pounds per year when this is developed. It's still in the earliest stages of development. They're still waiting for their last permitting and environmental impact statements to be approved by the federal government, et cetera. But this is going to take years and years to develop. So even though we're at this price that is incentivizing some project development on a global scale, it still is years away, and supply response just can't happen quickly. So then we look at when we expect sufficient supply to come online to actually balance the market. Realistically, we're probably 5+ years out. What's going to happen between now and then? Well, we think the utilities that have buying to do are going to have to come to the table and buy, and they're going to have to pay what the producers want. It's a seller's market, and the entire industry knows it. So part of what we're seeing in terms of this current spot price and the moves that we've seen which have been, August until now, over the past 3 months, we've gone from $55 to $81 a pound, have been on relatively low volumes in the spot market. So what's happening? Well, former sellers are turning to buyers, and people that do hold inventory are holding more tightly onto that inventory. So essentially, it's just the price is what sellers are willing to sell it at. And some of that volume into the spot market comes from offtakes from existing producers that have an offtake with traders, and the traders will sell a little bit every month. So they're not necessarily trying to hang on and hodl uranium for years. They are traders and they will sell. But this price is not incentivizing any particular project. So there's no real reason it's here. With all of that said, we're going to get into a situation, and we're very quickly approaching that situation, but probably in the next 12 to 24 months, where multiple utilities are going to be competing with each other for minimal available pounds in the market.
Yeah, Justin, that's going to be interesting to see how this starts to develop when you start seeing more and more utilities get into the space. And for a lot of them, the light bulb has gone off. Even some of the larger trade publications and some of the larger nuclear power sites and companies have started putting out information that some of these moves are going to be extended moves to the upside, and it's going to be a little stickier than maybe they thought. But you also have the supply demand fundamentals like you do in any commodity, and they're a little different for uranium in that there's about 440 reactors worldwide, but there's all these planned and proposed nuclear plants. There's plants under production, but they're coming from places that we wouldn't have even imagined maybe even 5 to 10 years ago. Countries like Sweden is saying, hey, maybe they'll start building plants again. There's African countries like Ghana and Egypt, Morocco, South Africa, Uganda that are thinking about, hey, we're going to start building some reactors too. There's Middle Eastern countries that are also starting to contract with Chinese builders to start building out reactors. You've seen a company like Cameco partner with Westinghouse to start getting a little bit busier on the reactor front. So how does this demand side from new reactors play into it? What is your outlook on the global growth of nuclear reactors, and how will that filter down into more demand?
Well, the demand from global growth of nuclear really is a delayed reaction, I suppose. So right now we have 391 gigawatts of nuclear globally from 436 reactors. There's 62 reactors under construction. There's hundreds in the planning stage and even more in the proposed stage. So it's a very, very robust backdrop for nuclear power right now. What's interesting is that because the nuclear fuel cycle moves so slowly, the utilities tend to buy uranium far ahead of time for their needs for a reactor that's actually under construction. So to give you one quick example of that, Ontario Power is building 4 GE Hitachi BWRX 300 small modular reactors at the Darlington site in Ontario. They are already in the market buying uranium, even though they don't expect these will be grid connected until probably 2031, 2032. So they're already out buying uranium right now. That uranium will have to be converted, enriched, fabricated into fuel. That whole process will take a couple of years. But another really important element is that the initial core load is 2 to 3 times the annual burn rate of a reactor. So whenever a reactor does the core change, where they take spent fuel out of the core and replace it, they usually take out 25 to 35% of the core. So a quarter or a third of the core they'll take out and replace with fresh fuel. So that initial core is at least 2x and sometimes 3x the annual burn rate. So these big reactors, some of these reactors are being built at 1,400 megawatts per reactor. The initial core load on these things is probably something like close to 2 million pounds just for the initial core load for some of these reactors. So 62 reactors under construction. Yes, many of those are in China. Yes, China has a large inventory. They're building out their own fuel cycle. They don't have a lot of uranium in the ground, but they have a lot of inventory. And so their initial core loads are largely going to be covered by this inventory. But look at the evidence. The Chinese have been big buyers this year and last year, and they're going to continue to be. So it's difficult to say exactly how soon the demand comes to the market. But again, we have yet to really see sort of animal spirits in the amongst the nuclear fuel buyers within the kind of the global nuclear utility community, let's say. And if we get to a situation where Utilities are actually scrambling for pounds and competing with each other, let alone potentially competing with other interests, such as financial interests like the Sprott Physical Uranium Trust. We're going to see prices far, far higher than that quote unquote incentive price that I mentioned earlier. So the demand is there. Even without these new builds, we still have, what the utilities have to buy. I mean, the utilities have 300 million pounds of purchasing to do in the next, less than 5 years. And that uranium is going to have to come from somewhere. And most of the big producers currently right now are mostly sold out of uranium for the next 3 to 4 years. So it's going to be interesting, Shad. I really don't know exactly how this is going to play out, but I can tell you that supply is insufficient until and unless we have these large new projects coming online. So we're talking about NextGen's Arrow, Denison's Phoenix, Global Atomics DASA, increase with the Uzbeks and increase from the Kazakhs. If all of that happens and happens to the extent that all of these individual companies and entities are saying that it will, we'll be in a decent place in 5 years. But between now and then, we have this very unique opportunity where the supply and demand situation is very clear. It's not easy to model, but it's just it's a grind. You have to crunch all the numbers and kick out a result, and it's quite shocking. You plug in a certain tails assumption and you realize we're short uranium. There's not enough supply to fulfill demand for the next 3 to 5 years until that new supply comes online. So it's going to be very, very interesting. And of course, all the positive news around nuclear, around the countries re-embracing nuclear. We're looking at 2 life extensions in Belgium that are about to get approved. Like you said, Sweden has done a 180 and is talking about building new reactors. South Korea did a 180 and is recommencing their construction of a nuclear power plant currently. The United States, along with 23 other countries, has signed a pledge at the COP28 conference that's currently happening right now in Dubai to triple global nuclear capacity by 2050. I mean, these are things that nobody ever dreamed of even 2 or 3 years ago. This is phenomenal to see, and it underpins this entire investment thesis that is basically based on a structural commodity supply and demand fundamental. So it's really a convergence of multiple fundamental factors. I can't really believe what I'm seeing, to be completely honest with you.
Yeah, Justin, I saw some of those comments from the United States and the UN out of the COP28 conference about their commitments for longer term nuclear build out. And we're seeing that echoed in so many countries, as you just highlighted, around the world. So there's definitely going to be the demand. To your point, some of the big projects like NextGen's Arrow or Denison's Phoenix project, some of the other projects in Africa that are slated to come online that are maybe lower grade but large projects, maybe they're there in 5 years or 7 years. Nothing ever happens as fast in mining development as everybody slates it. All companies are optimists by default, but the real world is it always takes longer and costs more to build these mines than people think. But it puts a weird scenario on the next 5 years, as you highlight. There are a lot of smaller companies, let's say in the US, that maybe they can only produce 1 or 2 or 3 million pounds a year. To the point you just made a little while ago, though, some of those reactors' initial load just to get them up and running would take their whole year's supply. So is there going to be a mad race into some of the smaller producers that can maybe do some immediate term contracts through in situ mining, ISR mining? Or will it be more of a story of utility companies and contractors paying up for these large projects in advance and sewing up future supply when a lot of that's already started happening? How did the next 5 years unravel with some of the small producers or some of the near-term producers?
Well, we were already hearing amongst the near-term producing development companies that their phones are basically ringing off the hook. Projects that were marginal even 12 to 18 months ago in terms of the pricing environment, when we were in the 40s, $40 a pound range. There were projects that need 50s and 60s that still couldn't really get the time of day from utilities. Now the utilities are calling them, even though, yeah, the price has overshot that incentive price for some of these projects. All of the projects that are in some stage of development or restart, they're all getting a lot of incoming calls from nuclear utilities right now. So, and it's an interesting dance that these developing companies have to play, because you can de-risk the finance aspect of development or restart by signing some contracts, forward selling some pounds, but you're also probably leaving money on the table considering the price environment for the commodity. So to the extent you can remain unhedged and be able to get into production without a lot of lower price contracts to deliver into, that's going to look good for your balance sheet. But in the meantime, you also kind of want to You want to befriend the utilities as well. Those are your customers. And if you tell them all to go screw, they might not come to you at a time when you want them to come to you. So you have to balance yourself as a developer to not only make deals with utilities that work for you on the pricing range. Usually, right now, that is going to be market reference contracts with floors and ceilings instead of fixed price contracts. And utilities always want fixed price, and the producers want market reference price. And now it's a seller's market, so they're getting it. But yes, there's a number of ISR producers in the United States that are getting into production or actually now producing. Encore Energy is one of them. Peninsula, UR Energy, Energy Fuels, Uranium Energy Corp. All of these companies are moving towards production or producing a small amount right now. And when they all get into full production, that's probably 3, 4, 5 years out. We'll get maybe 5 million pounds out of the United States. That's going to help. And yes, they'll have especially US utilities knocking down their door for that uranium. So that's already started to happen. There's some smaller developers in other places. You got Boss Energy in Australia that's basically just got into production recently. Not a huge producer, but they'll get something out of the ground. I know that they've had a lot of attention from utilities, although they've remained mostly, if not entirely, unhedged to this point. But these big projects, the ones in the Athabasca I already mentioned, and then the big Namibian projects, I think some of these Namibian companies with the very large low-grade projects will have investment decisions and updated feasibility studies in 2024. So hopefully we'll hear some more news on that front of these projects getting built. But to your point, to my point, it's going to take years, never happens on time, never happens on budget. I'll give you an example. The Chinese bought the Husab deposit in Namibia from Extract Resources. Off the top of my head, I think they paid north of $2 billion for it. They expected a much easier process of development. The development of this mine cost them more than $3 billion. So they were more than $5 billion to build the Husab mine. And this is similar metallurgy to some of these other projects, large, low grade. Now it's rocking. Now they're producing 12, 13 million pounds a year coming from Husab. But that's what it cost them to build it. A lot of lessons learned, I'm sure, with that development, but nothing happens on time, on budget, and especially in the uranium world.
That is for sure, Justin. And it also seems like in this kind of an environment, companies are willing to make new alliances or do things a little differently. Just a year or two ago, we saw a lot of development stage companies actually buying uranium in the spot market, which was kind of a new development. We hadn't seen that before, to get ahead of the contracting cycle, and it looks like that was a cogent move. We've also seen a few M&A deals in the sector, not that many. You brought up Encore. They had taken over Azarka Uranium as an example to beef up their overall footprint in the United States for ISR mining. And just speaking of them, recently, even just today, we saw a transaction with Encore and Boss Energy that you mentioned in Australia, where they're going to be working together. And there's kind of an exchange of properties for a stake. There's some cash in the deal. There's some percentage ownership in the stock. But we're going to see new alliances. How do you think this sets us up for, let's say, mergers and acquisitions in this kind of an environment where prices are high and a lot of companies still haven't caught up valuation-wise with where the prices are? Will we see more M&A? Will we see more alliances between companies? What do you think the lay of the land is there, Justin?
I think we're definitely going to see more alliances and some more consolidation in the sector. And the primary reason for that is there's only so many skilled people that have actually built projects before. So skilled labor and those that have the skills to build uranium mines are in very, very, very short supply. Drillers in the United States are in extreme short supply, and all of these companies that are operating in the United States are clamoring for these drill rigs. That's just one example. And this is a sentiment that was echoed across the industry at the recent NEI conference that I attended in Charlotte, North Carolina, back in October. Is everybody is seeing a shortage of skilled labor, not just on the mining side, but on the actual nuclear utility side as well. So it's across the board. Skilled labor is a constraint, and for that reason, and possibly that reason alone, we're going to see more consolidation in the sector. And the deal like that was announced this morning, I think, makes a lot of sense for both companies. Boss has some very highly valued paper, let's call it. So I think that was smart for them to make a move and spend some of that equity in order to acquire further asset. And Encore has a bunch of development projects that they want to get going. They've got multiple projects in Wyoming. They have a project in South Dakota, and then they have expansion they can do in South Texas as well. So having an influx of cash They sold 30% of Alta Mesa for $60 million. It's going to help them out as well. So I like it. It's overall, I think it's showing some cooperation and consolidation in the sector. I think we're going to see a lot more of it going forward.
All right, Justin, and just as we wrap up, any final thoughts you want to leave investors with that are maybe watching this from the sidelines and thinking about looking to get positioned here in the medium term, or anybody that's been in the sector and has had some nice gains, but is maybe worried things have gotten too frothy and maybe this is the end of the move? What bigger picture thoughts would you leave people with for, let's say, as we move into 2024?
I would say expect 2024 to be a really good year. I really think this is a year where a lot is going to come together. This year was a year where the thesis sort of proved itself. We saw an enormous move in the price of uranium. We've seen the utilities finally step up to the table in a major way on the contracting front. And a lot of utilities that had remained on the sidelines in 2022, largely waiting to see if the conflict in Ukraine would kind of blow over and business as usual would go back to what it was just, a couple of years ago. That hasn't happened, and a lot of those fence-sitting utility fuel buyers have been coming to the table this year, and there's a lot of buying that needs to happen. You have to understand that nuclear power plants are multi-billion-dollar strategic assets. You can't not fuel them. You can't have a $10 billion nuclear power plant that has an 80-year lifespan and you're in year 35 or year 45 and say, oh, whoops, we didn't buy the uranium. We're not going to. That just doesn't happen. Utilities will pay whatever they need to pay. That's what makes this commodity extremely unique. While it is fungible, U3O8 and UF6 are fungible. You have a chain of custody for uranium. So uranium that was mined in Kazakhstan, you know where it came from when you're looking at that can of yellow cake. So if it had to get shipped through Russia, you know that it had shipped through Russia. It's not fungible in the same manner as something like oil is. It's a very, very unique commodity. And then lastly, I would say is that it seems like it's practically a guarantee that we're seeing an economic slowdown in the United States and to some extent globally. I think that a lot of people have recessionary fears around commodities, and I just have to say that uranium doesn't really get affected by that. And we've seen that this year, and this year proved that. So while we've seen oil pulling back, we've seen nat gas pull back, a lot of the other commodities, copper, lithium, a lot of these commodities have pulled back, and uranium is up 70%. The reason for that is these reactors operate recession or not. And while they might cycle down 5 or 10% in their electricity output, generally speaking, typically where reactors are built, they are base load. So they're not kind of that marginal electricity on the fringes like usually is utilized for solar and wind. They are the base load power. They stay online, they operate. And a recession, whether it lasts 6 months or 2 years, doesn't affect the buying that the nuclear utilities do to operate their reactor because they are looking so far ahead. Utilities right now are buying for the late 2020s into the 2030s and to some extent into the 2040s even. That's how far ahead utilities look to secure their needs. So recession is not going to affect the commodity itself. Will it affect capital markets? Of course, sometimes that is the case. And we've seen equities, in our opinion, underperform the commodity this year with few exceptions. So we think that reverts to the mean, and we think that the equities are, generally speaking, with few exceptions that are overvalued here, are pretty much a screaming buy compared to an $81 commodity. And you also have to look at inflation. 81 bucks a pound is 55 bucks a pound in 2006. We have a very, very long ways to go for this thesis, and we expect fireworks for 2024.
All right, Justin. Well, we'll wrap it up there. It was great having you on the show again. And we'll try to get you on a little more regularly because there's a lot of other topics to still get into in the uranium space and the nuclear fuel space. If people like what Justin has to say here and want to follow along with his work, definitely click on the link below. It takes you over to Uranium Insider, and he's pretty active over on YouTube as well. You can check out his YouTube videos. And Justin, until next time, always looking forward to our next conversation.
Thanks so much for having me, Shad. Happy to come back anytime.